Good morning, Checkmate crew. Today is August 26th. It is 9:15 a.m. We're 15 minutes before the market opens. Today is the first session of premium plays. Okay, so we have high noon highlights on Tuesday, Wednesday, Thursdays at noon, but on Fridays in the morning, I think I'm going to do a different program where instead of, in high noon highlights, we'd like to talk about the underlying market conditions, the market data, all positioning, swing trades. These are the type of thing we talk about in high noon highlights. But on premium plays, this is going to be where we talk about premium generating strategies. Okay, I believe to build long-term wealth, you need to be able to generate yield and income from your assets. Okay, so this is going to be more longer term focused, less short term thinking. We're going to think more longer term on this. We're going to be thinking about building longer term positions and selling options against them. Now, we're not only going to talk about just covered call writing, we're also going to talk about other strategies that are longer term that involve premium selling, like poor man's covered calls, or just generating income just by selling vertical options as well, vertical spreads. Okay, so this is not something that we're going to discuss all in one day. Every day we're going to be working on this. Every week we're going to go over a new topic. Okay, every week when we acquire new shares, after we get the Moab signal, the mother of all buy the dips that we talk about on high noon highlights, we're going to be buying more shares of more stocks. And when we do, we're going to be looking to generate premium income on that. So first of all, let's get right to it. Why generate premium, and why even sell covered calls? Okay, so here's the thing. Let's say you buy a stock for $100. All right, if you buy a stock for $100, it could go up or down, right? It could go up to 105, or it could go down to 105, right? If it were to go down, or if it were to go down to $95 a share, you would want to hedge that, right? You would want something to hedge it. So one of the ways that a lot of people hedge their shares is they sell covered calls. It's a way to generate income from your holdings. Okay, so basically when you sell options, what you're betting on is what is not going to happen. Okay, what is not going to happen? So let's just go through an example right now. Okay, let's say SPY. Okay, let's go through SPY real quick. Okay, give me 1 second here. Okay, so let's go to SPY. Let's say you bought SPY, which is the S&P 500 ETF. Let's say you bought it yesterday. Okay, the market hasn't opened yet, so today's candle hasn't even been drawn. Let's say you bought it yesterday at the lows, 415. Okay, you bought SPY at 415 yesterday. All right, and let's say at the close yesterday. Okay, yesterday it closed at around 419.51. Let's say you thought, you know what, today SPY is not going to close above 425. Okay, let's say you thought that, it's not going to close over 425. All right, what you could have done is sold a covered call for every 100 shares that you own of SPY. You could have sold one contract of the of a covered call. Okay, now let's look at some scenarios here. So if that covered call, if you sold it at the end of the day, it was around 52 cents. So again, multiplied by 100, because this is the price per shares. You have 100 shares. So it would have been like, let's say $50. You would have made $50. You would have kept $50 of premium if you had sold that call after you had bought shares, 100 shares at 415. So You bought 100 shares of SPY at $415 yesterday in the morning, and then at the end of the day, you thought tomorrow by end of day, we will not close above 425, so you decided to sell the 425 calls expiring later today for $50, okay, per contract. All right, let's say at the end of the day today, we end at 425.01. Okay, 1 cent over your strike. Okay, since you sold those calls, you are obligated to sell your shares at the strike price, which is 425. Okay, which is not a bad thing, right? You bought it at 415 and you're forced to sell at 425. You're gonna profit that $10, plus you get to keep that 50 from selling that call. All right. So your upside is limited. You get paid to lose out on some of the upside. Okay, that's what happens when you sell a covered call. All right. The important thing is this: when you sell a covered call, you always want to sell at a strike that is above your cost basis. So in this example, your cost basis is 415 because that's where you bought it at. That's where you bought the shares at. So your cost basis is at 415. Obviously, you probably don't want to sell that covered call at strike 414, let's say, because if you if you close over if it closes let's say 414 and a half, you're forced to sell at a 50-cent loss per share. Okay, well, yeah, and then you get to keep the premium, and the premium would have made it a profit. But generally, when we sell covered calls on a forever asset like SPY, we usually do not want it assigned away from us. Okay, when I sell covered calls, I'm trying to keep my shares forever. Okay, I'm never going to sell my SPY shares. Never. Okay. And I'll tell you why, okay? So, for me, SPY, like I said, is a forever asset. I don't want to sell it. For me, the primary thing is to create income off of my SPY shares forever. Some of you guys who've been with me for a while, you've heard me say that the price of each SPY share is irrelevant to me, okay? It's irrelevant. Why do I keep saying that? I've been saying that for years now. So why is it that I say that? It's because I know the income that I can generate from my SPY shares forever. Okay, this is what I do constantly. All right, week in, day out. I don't day trade on my swings or on my speculative account, but I do actively sell premium against my SPY shares. Okay, I sell covered calls, and the dividend that I make from it, I know I'm going to be always making that money year in and year out. And my goal, my plan is to always make about 0.2% per week, which comes out to be about 0.04% per week, which is about 85 to 90 cents per share per week. That gets me 10% annualized per year. Okay. So my worst year of selling SPY shares, I started accumulating SPY shares back in 2016, 2017. And my worst year in selling SPY was probably 2017. Just because at that point, the VIX was low. It was like this low grind up. I think I made 15% in selling SPY premium that year. Okay. 2019 and 2021, when the VIX was high, we made more like 25% off of the SPY shares. Okay. So all of my money that I trade with that you see on High Noon Highlights, that is my speculative account. All the money that I generate from selling covered calls on SPY goes toward my speculative account. Okay. So again, this price of SPY is irrelevant because I know I'm always going to be making that 10% or more per year plus that dividend. All right. And in those trending stable markets, I usually sell 0 DTE, 0 days to expiration to 3 or 4 days to expiration. So if it's like a Monday, I might sell like the Wednesday expiration or the Friday expiration. These days, because of the vicious bear market rallies we've been having, I've been selling them on a week-to-week basis. So on a Friday or on a Monday, I'll sell it for either the next Friday or the next Monday. And I try to do it on a weekly basis. Just because that allows me to sell a little bit more further out the money. So the last thing that I want is for my shares to get assigned away from me. Okay, that's the last thing that I want. All right. So all this money is what I put into my speculative account. Why is this important? Why am I going over this? Because this is what really helps me generate my wealth. All right. It's counterintuitive. I get it. Like SPY is slow and boring. And a lot of you are thinking to yourselves, I'll buy SPY shares after I make a lot of money in the market, after I trade and do all these swing trades and YOLO these, calls and puts. Actually, it's the other way around. It wasn't until I started accumulating SPY shares that I started doing better in my active trading. All right. And the reason for that is because I don't have to place price stops on my positions. I can use more data or certain conditions, as my stop instead of a price. For some people, it's like, oh, if you lose like 20% of the value of the position, I stop out. For me, I more stop out based on certain data conditions. Oh, when liquidity increases and makes a higher high, that's when I stop out. So I'm able to hold much longer because, first of all, I use good risk management. Even on my speculative account right now, and even in my spec account, only 8% of it is on play with all the put spreads and the risk off spreads that we have. What those spreads are. In high noon highlights, I go over them at the end of the day all the time. The FEZ, the EWT, the QQQ, IWM, all those put spreads that I have. Only about 8% of my spec account is in play. Plus, the whole account was made through premium generating. So there's no fear in my game, okay? And that allows me to not get shaken out, and I can really lean on my data. And that gives me a huge psychological edge. Most traders underestimate that psychological edge that comes from generating premium and knowing that you can always generate premium from your holdings. Okay, that's a huge edge that you have. All right, and most people underestimate that. All right, and so that's one of the sources of my edge. So let's get right down to it. Let's go over my strategy. So what my strategy is, I like delta 10 to 20. Okay, I usually sell delta 10 to 20, and again, right now, since we're in this like very choppy market with these huge bear market rallies that are possible. I really want to be, I want to be as out the money as possible. But if you go too far out the money on these 0 or 3 day expirations, you don't really get that much premium. So I go out about a week. So right now I'm looking at the Friday, September 2nd. I already have an active order. It's not on this account. My SPY shares are at a different brokerage. I use Thinkorswim for my spec plays, but for my SPY shares, they're housed at a different brokerage. Right now, I have an order for the 435 strikes for next Friday for September 2nd at 87 cents. Okay, 87 cents. If this jumps up today to 87 cents, I will sell that. 87 cents happens to be 0.2% of 435. Okay? That's my quota that I need per week in order to generate that 10% income that I need. All right. Now, why did I choose 435? Right now, as I told you guys yesterday on High Noon Highlights, right now we're about 3 weeks before the biggest monthly options expiration in SPX. Okay, so let me go over that yesterday because apparently a lot of people who were on the call yesterday didn't get the memo of what we talked about yesterday, but okay, fine. So I'll go over it again. So I told you guys yesterday, this is a record options expiration as far as open interest is concerned. This is not apathetic market. Okay, it's not apathetic at all. It's very much there's very much strong positioning on both sides. There's a lot of people saying, oh, the market's going to tank, all-time lows. And there's a lot of people saying, oh, there's going to be all-time highs after, this, after the Fed speaks. So there's a lot of conviction on both sides, all right? Generally, the market positioning is like a bell curve. Let me actually get a picture of a bell curve for you guys, just in case. Bell curve. Okay. Usually, if it's an apathetic market, where there's not really that strong of a positioning, you see a bell curve like this. Most of the positions are centered around at the money. Okay, not really that much strong conviction. However, when there's strong conviction in the market, you see this reverse inverted bell curve. Lots of bets on both sides that are out the money. Okay, so that's what we have right now. And generally, when we see these types of markets that have huge conviction positioning, generally what we see is that the market will chop. Okay, the market will chop in both directions. It will go really strong in one direction and then get immediately faded. Okay, and that's what we're expecting. That's what we've been expecting here at High Noon Highlights from the market as we get closer to OpX. I think today and into next week, I think the market is way overhedged. We're probably going to shoot up as a lot of those puts are going to get cashed. Again, what happens when puts get cashed and when VIX falls? The market maker has to buy those puts and has to buy the underlying to even out his books, right? So I think the market's going to shoot up. I said that 420, 425 zone, that's where it might go up, and then it gets faded from there because liquidity, if we look at our liquidity data, our high-low, our junk bonds AD, it is decreasing, all right? So that's why that was the thesis, all right? Why then did I choose 435? Well, first of all, we have huge OI. Look at that, 47,000 right here on SPX for 4,300. Not only that, okay, not only that, but right now, if you look at the dollar, okay, if you look at the dollar positioning right now, I think a lot of emerging countries, and we've talked about this in previous High Noon Highlights as well, I think a lot of emerging countries started buying dollars right here. There's a huge net long position on the dollar right now, okay? I think if after Chairman Powell speaks, if all those, because all this buying, all this positioning is all old data, right? Everybody already is in these positions. So if the dollar unwinds after Chairman Powell speaks, definitely the lid on the increase in price and indexes could go up. Okay, dollar coming down is loosening financial conditions. So that just means we can overshoot that. So if options positions unwind, also dollar positions unwind, definitely I can see us getting to that big put strike at 4,300. But because the dollar is dropping at the same time, we might overshoot it. That's why I chose 435 as my strike for next week. Okay, so not only is it based on the premium and my quota to get my 10% per year, I also base it off of the market positioning as well. Okay, so let's just take a look and see if my order is close to filling or not. 435. No, it is not. So we'll see what happens. I am willing to take the 430s at the end of the day if we keep rallying. Okay, so at the end of the day, I may switch my order up to 430 if we don't make a meaningful rise, and let's say we get to like 425, 426 or so. We'll see. But I do have a standing order for 435 at 87 for now. But at the end of the day, I may reassess and I may try to get the 430. Or I may just go without selling a covered call over the weekend, because usually when there's a Fed meeting or something like that, it can take the weekend for the rest of the world to digest, and the real move can happen after the weekend. So I may just de-risk and just not sell a covered call today if I don't get my fill on the 435s. So hopefully that kind of put things into perspective. When the markets get a little bit stable, I'll show you guys more like 1 day, 2 day, 3 days selling, those more shorter, like, on a Monday selling the Wednesday expiration. I'll show you more examples of that. But right now, because of the vicious bear market rallies we could have, I want to go a little bit more out. I know some other people who do SPY plays as well, and they sell premium on a regular basis. Sometimes in these market conditions, they don't even do a week. They'll go like 2-3 weeks out, or even a month out. Hey, whatever makes you comfortable. Okay, for me, I'm comfortable doing a week to week, from Friday to Friday, or a Monday to a Monday. I'm comfortable doing that in this market condition. You're going to have to just figure out your own style. But that's what I do. And I always choose, I always like to go delta 15 to 20. When do I start managing my positions? Once the delta gets to about delta 30 to 35 or so, what I will do is roll my option to a later date. What does rolling an option mean? So let's say I sold, let's say I sold the, let's say I sold the 430, yeah. Let's say I sold the 430 strikes for $1, okay? And let's say this keeps going up to 425. At that point, most likely these 430s are probably going to be delta 30 or so. What rolling means is, in one order, you buy back the 430s, okay? And then you sell a later dated option, perhaps at a different strike. Okay. Usually, if your delta is low enough, around 30, 35, you can actually roll just in time, keep the same strike, and collect more credit. Okay, collecting more credit. All right. When I roll, I try to roll and collect more credit. That's why I start rolling at around delta 30 to 35, because once you get to around delta 50 or so, you may end up in a position where you start losing out on a lot of that credit, okay? Because your short dated strikes have more gamma, so they start rising faster after a certain point than some options that are further dated, okay? So you start risking the amount of premium you can make, all right? So just as an example, let's say you wanted to roll. Let's say you had sold an option yesterday. Let's look at this one, delta 32. So let's say yesterday you sold the 422 calls. 422 right now is at a delta 31. Let's say you get scared, you get spooked, and you just want to roll and reduce your risk. Right now it's at 116, 117 for 422, right? Well, 7 days from now, those 422s are $3.44. So you may, those are at 120, right? So you don't even have to roll it to the same strike. You could actually roll it to 427, which is at 168, but you bought yours back at 120, so you're collecting 40 cents to move up $5 in strike and also give yourself another week. You see that? Let me know in the voice chat text in Discord if you guys don't know what I'm seeing or don't know what I'm talking about. Okay. Let's say the same thing. Let's say yesterday you sold the September 2nd calls. Now they're at delta 30. Let's say you sold the 425s when they were in delta 15, delta 20. Now they're at delta 31. They're $2.30. You're spooked. You don't want to hold that. You want to reduce your risk a little bit. So you want to roll to September 9th, which is 2 weeks away. Those 425s, look at that. They're 351. Okay? They're 351. What was it here? 425? Oops. That was the wrong one. Let me see. What's the 425s for next week? What did I say? I forgot already. 230. Okay, so $2.30. And if you roll it to just 1 week out, you keep the same strike. You can collect $1.20 per share just by rolling it. Now, me usually I try to roll it out and up. Okay, out in time and up in strike. So since those are 230, I can even go all the way out to 428, go up 3 strikes, and still collect about 10 cents of extra premium as I roll out and up. Okay, so Delta 30, 35, that's the sweet spot. That's where you can roll out and up and collect more premium. When I roll, I want to roll and take more premium. I want to take more premium because that increases my chance of profit. Okay? When you get paid up front, your chance of profit goes up. That's why selling options, that's why you have such an edge. Okay? Because you get paid up front. All right? You get paid up front, and you have time value on your side. You have that theta on your side. Okay? So basically you're just betting, you know, if you sold the 428 calls for September 9th expiration, what you're saying is that it is not going to expire and be over 428 at expiration. So when you're selling options, you're basically betting on what is not going to happen. Okay? And this way you can generate premium. And again, my worst year in generating premium, 2017, I made 15% on my SPY shares. Okay? And all that money I've been generating premium has funded my spec account. So that's why there's no fear in my game. I don't use stops based on price. I use stops based on data conditions. That's why I'm able to do that. I know a lot of you have DM'd me over the past few days. Oh, Mickey, like, aren't you scared? You started legging into your positions and the market's been going up on all your puts. I'm like, no, because, you know, first of all, they're longer dated. And not only that, I legged into them. I didn't buy them all at once. So first of all, I used good risk management. I also kept the positions fairly small. And not only that, because this is an account that's all basically free, it's all premium money that I know I'm going to get again next year. You know, I can base my stops on conditions rather than price. All right. And that way, that's why I don't have any fear in my game. That's why I can buy puts. Market still goes up and I can still walk away from my screen. No problem. Touch the grass. Okay. That's where a lot of my edge comes from. It's a psychological edge. Nobody talks about it. You go to Twitter. I'm part of a lot of different trading discords as well. Nobody talks about psychological edge. But this is really the foundation of my psychological edge. Nothing can really shake me out unless the data changes. Okay, and it takes a lot to change macro data. Okay, so you know, risk management plus the fact that I have this premium selling, plus the fact that I know that I have all these SPY shares in my long-term account that I can generate income for the rest of my life, gives me that edge. That's where my edge comes from. All right. How many positions am I selling at the same time? So I actually have 4 stocks, 4 tickers in my long-term account. I have 4. Okay. Most of it is SPY, SPY, S&P 500. My second biggest holding is Apple stock. My third is Chevron, and my fourth is Boeing. Okay, those are my 4 positions. So I do 4. I think 4 is a good number for me, and it's a big range. They're all dividend paying. Well, Boeing's not a dividend paying stock anymore. You know, I got into Boeing after the whole COVID, when it crashed down into the 90s. That's when I bought Boeing. So Boeing hasn't paid a dividend since then. But Apple and Chevron are 2 very good dividend paying stocks. Chevron, especially Chevron, with my cost basis, I think I'm making like 8 or 9% dividend per year, because my cost basis is down in the 70s and 60s. That was one of my first stocks I started accumulating when I was young, was Chevron. I still have it. I'll never sell my Chevron shares. I'll never sell any of those. Okay, these are my forever assets. Most of it though is SPY, S&P 500. All right. So my forever shares, so not only that, not only can I generate 10+% per year on my shares from selling covered calls, I also collect a dividend. Let's say the average dividend rate around all of them combined, let's say it's around 2.5%. So it's about 12.5%, pretty much low risk guaranteed that I'm going to make about 12.5% cash yield on my long-term investments. Like I already know. I'm going to make 12%. And back in 2021 and 2019 when the VIX was high, I made 25%. 2020, I made a ridiculous, I made over 50% in selling premium, but those years are rare. 2020, we had that COVID, VIX went up to 80. That's a one-off year. We're probably never going to see a year like that in our lifetimes ever again. So I don't even count that in my statistics. But if you must know, I've made like over 50% just in selling premium in 2020. Yeah. So when VIX is high, but selling premium is just like, it's God's gift to green earth. I mean, it's just an awesome thing. And again, that's where my edge comes from. That's where all this spec account money came from. And that's why when I built those put hedges, I was, that's why I call them hedges. They're not just swing positions for me. They're also hedges for my long-term portfolio. So having that long-term mindset, having that psychological edge, and then having the right risk management in place, it really gives you that edge. It really does. Okay. And so most people think of it, unfortunately, in the opposite way. They actually want to make all this money swing trading and YOLOing on calls and puts, and then after they make a lot of money, then they want to get into SPY. I actually think it's counterintuitive, but I think it's the other way around. Once you start building up these forever assets, and I get it, it's going to be a little bit of a slower process, but once you start getting into these forever assets, that edge allows you to actually profit more. And so what I've noticed was after I started accumulating SPY shares, my equity curve started getting really consistent. It started getting really consistent, and that's when the exponential growth happened, because it's large losses that keeps you in the hole, because you're spending all that time trying to dig yourself out of that loss. Whereas if you keep your, if you have these forever assets that always pay income, you don't really have to worry about all that. All right, that gives you a huge edge. Okay, so that's my SPY selling strategy in a nutshell, just on the call side. Okay, that's just on the call side. That's what I do. All right, again, Delta, I like to keep it under 15, but if the premium is right, I may go up to 20. Okay, but 20 to 10, closer to the 15-10 side if possible. And again, right now I have an order on my long-term account to sell the 435 strikes. The 435 strikes for next week. Oh, actually, the 435 strike for Tuesday and Wednesday next week is not bad. I'm going to remain patient. Just in case the market really goes up after the Chairman Powell speaks. I think it's a very good possibility, because the market is so overhedged and there's so many long dollar positions. It could happen. It could overshoot like 430, go to like, 431, 432 before coming back down. So if I'm going to be taking a weekly, I might have to be patient, just for risk management. Okay. But I do have an order for September 2nd, that's next Friday's, for 435 at 87 cents. If this gets to 87 cents, it's automatically going to get sold. Okay. And again, the reason why it's sold at 87 is that 435, it's above that 430 strike, just in case if it overshoots. All right. Not only that, if it's at 87 cents, it's at 0.2% of 435. 0.2% per week gets me a 10% average. So that's my quota. My quota is I need to make 0.2% per week. All right. So that's my SPY call selling strategy. All right. Let's actually go over some oil companies, because I know some of you guys are in oil names too. I'm in Chevron myself. Remember yesterday our oil plan? I told you guys about our oil plan, which is CLZ22, the December contract. If we get to, hey, we're almost at our buy level. 90. Remember? 90. Oh, are we going to get there? Oh, we might almost get there. But anyway, right here is where we're going to short oil, right? Around this 105, 110 zone. That's exactly the same area where I'm going to sell covered calls on my Chevron shares. Okay? My Chevron shares. I don't know when that's going to happen. I don't know when that December contract for crude oil, I don't know when it's going to get to 105, 110. But if it does, I'm going to sell it maybe a month or 2 months out in the monies. All right? Right now, the in the monies, let's say for 2 months out. Oh, look at that. $8 a contract. Oh, that's awesome. That's like 5%. That's awesome. Okay? That's awesome. 5%. And what I'm going to do is I'm going to take that money, that premium, that $8, and I'm going to buy some protective puts. All right? Actually, I can buy 2 150 puts and still collect $2 of premium because they're $8 a piece if I sell the 165 calls. And with that $8, I buy 2 $3 puts at strike 150. That's 6. So 8 minus 6, that leaves me $2 of extra premium left. So I can still keep premium, still generate income, and protect myself just in case if the shares drop. Cash out my shares if the shares do drop and buy the dip with that. And that's how you compound wealth. That trade, we went over that trade before in High Noon Highlights. It's called the protective collar. The protective collar, like you know, ever since I can remember, I've been popping my collar or whatever that song is. Yeah, or you know, the collar on your shirt. It's because the risk, the payout structure looks like a shirt collar. That's why they call it that. But anyway, it's when you sell a covered call and you use that premium on your covered calls to buy protective puts. All right, I do that too. Technically, that's what I'm doing with my put spreads on all these indices, right? I sold all this call premium, and now I'm using it to buy protective puts. Now, I'm not doing it on the same expiration. I'm not doing it on the same scale, but the principle is the same. You're taking money that you got for free selling covered calls, and you're using that to protect yourself from a downturn in the market. And when the downturn happens, you cash out and you buy the dip with those gains. That is how you exponentially grow your wealth in good times and in bad. Actually, I'm a huge long-term bull on the stock market, but I make more money during bear market years. Isn't that funny? Isn't that the funniest thing you've ever heard? I'm a stock market bull. I'm a long-term bull, very bullish on long-term in the stock market, but I make more money during a bearish year. And this is the reason why. Okay, this is the reason why. All right. So today was just the first episode. Okay, today was just the first intro into selling options and into SPY and into long-term strategies. We're going to do more of this. Okay, we're going to talk about more protective collars, how to choose strikes on a protective collar. We're going to go over selling vertical spreads. What if you don't want to buy the shares and you just want to make premium on a week-to-week basis? There's a rolling vertical spread strategy that I have. We can go over that too. And also for some of you guys that have smaller accounts, maybe you do want to sell covered calls on SPY, but there's a way to do it without 100 shares. It's called a poor man's covered call. So what you do is you buy in the money leap. Okay, and in the money leaps are way cheaper. Right now, let's for example, a year out, you can buy, let's say the 370 calls for about $7,500, $7,600. And with that $7,600, you buy one contract for the 370 calls for September 2023, and then you can sell covered calls against that without any additional collateral to your broker. Okay, you don't need any extra buying power once you have this leap to sell a covered call against it. Okay, so there's a way for you to sell covered calls on SPY without, what is it, $41,000. Actually, if you believe that we're going to be higher in a year from now, you can actually buy these 370 calls that are dated for a year, 7,600 and then start selling covered calls against that. It's a poor man's covered call. Again, we'll go over that. There's certain strikes you want to look for. There's certain back tests that I've done, and I'll go over that in the next episode. Okay? Any questions? Any comments? Any rude remarks for me? How do you guys like this series or so far, today's episode? How do you guys like it? Was this helpful? Thumbs up, thumbs down? Rude remarks? Give me some feedback. Thumbs up. Okay. So yeah, that's in a nutshell. This is also another reason why I, MSC, you and I, we've talked about this for like, I don't know, almost a year, where we're talking about where can we sell covered calls on Ethereum, right? Where can we just put our Ethereum coins as collateral and sell covered calls against that? This is the reason why I've been asking for that, because I think Ethereum could be a forever coin. I wouldn't want to put too much of my net worth into it, but I could see owning Ethereum forever and generating covered calls off that. And plus the IV is just sky high. I mean, the income from that is just going to be, oh my goodness. You already know. You already know the IVs and all that. You already know. But yeah, that is my SPY covered cost strategy. Oh, also too, in the future, we're also going to be talking about cash secured puts. How to get a position, how to get a stock position for cheaper than what the market price is. That's what cash secured put selling is, and I'll go over that perhaps next time. Perhaps next time we go over cash secured puts. Probably it will be a better market condition to go over that as well too. All right. Yeah, can I do it? One of our members is asking, can he sell covered calls on ETH or Bitcoin? So as far as I know, there is no platform that allows you to use your ETH or your Bitcoin as collateral to sell covered calls. So here's the thing. When you just sell a naked call, there's collateral involved, okay? You have to actually post up assets to your broker just in case if the trade goes against you. Now, here's the thing. When it's a covered call, so let's say in this example, SPY, let's say you have 100 SPY shares. Let's go back to our 0 DTE thing. Let's say yesterday you sold the 420 calls yesterday. And let's say today we close over 420, okay? And you have 100 shares, all right? You don't need any more buying power posted as collateral because you already have your 100 shares. If your sold call expires in the money, they'll just take your shares and sell it at the strike price. So there's no need for any more buying power to be posted as collateral. That's the beauty about selling covered calls on a forever asset that's designed to go up. And believe me, SPY is designed to go up over long periods of time. Over long periods of time, the S&P 500 is going to go up. Look at any rolling 10-year period on the S&P 500, all right? It usually is up, all right? I think there's only one rolling period where it wasn't. I think it was like, I believe it was like 99 to 2009. That was like the only 10-year rolling period where it wasn't. But if you reinvested your dividends, it was positive, okay? So if you reinvest dividends, there's no rolling 10-year period where you're negative, okay? So this is an asset that keeps going up. It is a beautiful asset to sell covered calls on. You buy 100 shares, you sell covered calls, you generate income for the rest of your life on it, okay? That's why SPY is such a beautiful asset. It's a beautiful asset. It really is. MSC, I see you're typing. Usually you have very insightful comments or very insightful questions, so I'm going to wait for this. Any other questions, comments, rude remarks? Everyone learn about, I appreciate that. I appreciate your kind words, MSC. Yeah, here at Checkmate Trading, we're not just about short-term trading. We're also about long-term investing. And let me just be 1,000% honest with you guys. And this is something that none of the other Discord heads, or this is something that not a lot of the other, like, Twitter, stock gurus are going to say. But if you're in this business for real, like if you're serious about this trading and investing business, 1,000% honesty, like honestly, most of your money is going to be coming from long-term investments and long-term plays. Short-term plays, if you do win, if you're a winner in short-term plays, it usually means your position sizing is small. So because your position sizing is small, you generally don't make that much profit off of it. And not only that, it's a lot of time and effort, okay? If you want to make maximum gains with the least amount of effort, long-term strategies, long-term portfolio building, and selling premium against quality assets is going to generate more return by nominal value than any other strategy out there. I don't care what anybody says. Okay? YOLOing options, swing trading, all that is meaningless to owning a forever asset and selling premium on it. Over the course of 10, 20 years, you will make more money on that than any other strategy. Okay? And nobody tells you that. Why? Why does nobody tell you that? Because at that point then, a lot of their members are going to just quit and leave. Why should I be a slave to my computer and look at these 1 minute charts and get abused by this 1 minute chart when I can set and forget, buy a forever asset, sell covered calls, and just walk away and set some alerts? And that's what I do. I use trading and investing as financial freedom. I'm not replacing one job for another form of slavery by being in front of the market. And let me tell you, I don't care what anybody says, day trading is a job. It is, your boss is the market and the short-term charts. Let's be real, okay? So for those of you guys who have jobs, who have careers, but you want that financial freedom, this is going to be your show. This is going to be where you capitalize and learn how to achieve financial freedom. For the rest of us, High Noon Highlights is also going to help us. The stuff that I talk about, the data and all that stuff, that helps with our long-term investing as well. But that's, a lot of that stuff is for the short-term traders. And we'll talk about some of the really important data for long-term investing on premium plays as well too. So don't feel like you're going to miss out if you just do this show over the other. We'll talk about all the important data and stuff for long-term investing as well. But, short-term investing, again, it's just a lot of work. It's a lot of effort. Again, even when I do short-term trades, there's swing trades. I try to take advantage of weekly, monthly moves because I don't want to be sitting in front of my computer all day, again, getting abused by the 1 minute chart. That's just not my form of financial freedom. That's not why I quit my job in corporate America. I didn't quit it just to have a new boss, Mr. Market, okay? I didn't quit my job just to do that. I like my freedom. Despite what everybody thinks, I'm not in front of my computer all the time. I do a lot of my own projects. I, run around a lot. And, what I'm trying to do is get maximum gain for the least amount of time in front of my screen during primetime hours. Okay. So that's that. So that concludes this episode of Premium Plays. Thanks for coming by, guys. Mike is telling me that Powell is live. Like that even matters. Let him talk. The bond market will tell us what really is important later today, possibly next week. That will be the real tell. The words coming out of these politicians' mouths, who cares? It's really about what the bond market reacts and how the market reacts to that. And that we probably won't see until the end of the day or possibly into next week. Most likely, we probably won't see the real move until Monday, Tuesday, or maybe even later next week. So I'm not too concerned about all that. Any other questions, comments, rude remarks? Going once, going twice. All right, well, that concludes our first episode of Premium Plays. We will be back at it next week. And next week, we'll go over another topic. Next week, we'll go over selling cash secured puts to acquire shares for the long term. All right, guys, Have a wonderful weekend, and I'll see you guys for high noon highlights next week, Tuesday, Wednesday, Thursday at noon. Have a great weekend, guys.